Hi there, welcome to Trading Day. I'm Andrew Bell. We're in for a treat. Today on the show, we're going to be joined by the Minister of Transport, Stephen McKinnon. We are going to talk about that major expansion at the port of Montreal. Of course, the government is anxious to back what it calls nation-building projects. And he'll explain why the money being spent on that bit of infrastructure will bring benefits. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canadian employment rose by just over 14,000 jobs in March. That was slightly below expectations. However, the increase follows heavy losses earlier in the year. Gains were led by personal and repair services, as well as natural resources. Meanwhile, the unemployment rate held steady at 6.7%, in line with expectations. Shares in Cogeco Communications dropping 8% after the company posted revenue and profit that missed estimates. Sales in its U.S. telecom unit came in below expectations. The company cut its full-year revenue and profit forecast and warned that sales are being hurt due to higher pressure on its U.S. cable internet subscriber business. Shares in Chorus Entertainment also taking a hit after revenue in the latest quarter came in below estimates. The Toronto-based media company and broadcaster reported a 15% drop in consolidated revenue, with its TV business the biggest drag. However, Chorus did see its overall loss narrow from a year ago. TSX stocks hanging in today, edging up about 0.5%. And let's have a look at the U.S. markets. The S&P flat, NASDAQ stocks poking upwards. Investors hanging on in many cases to see how these U.S.-Iran talks on the weekend work out. So we just got a U.S. inflation number for March indicating that prices rose at a pace of more than 3%, but a lot of that was because of rising energy costs due to the Persian Gulf conflict. Our guest says that the Federal Reserve is likely to stand pat for now, but he also argues that what matters isn't where rates are going, but where the economy and markets have started from. Let's get more from Mike Dixon, head of research at Horizon. Thanks very much, Mike. What do you mean where the economy and markets started for? Walk us through your thesis, if you would.
Sure, and thanks for having me here. Look, we've had some good positive developments, of course, this week with the Iran conflict, and I think it's important for us to zoom out a little bit and be reminded of where we came into this conflict, and that was from a period of strength and tailwinds. And so, specifically on that, we've had a very strong consumer here in the U.S. with really powering economic growth broadly for many quarters in a row. We've also had very strong underlying fundamentals, powering the corporate sector, inflecting quite a bit higher year over year and still intact. And then you have some fiscal policies on both the public and private side that are really set to provide tailwinds there. And those are the starting conditions that we came into the year with. And, while this conflict is by no means resolved, there has been some uncertainty removed. And I think it's important to kind of revisit, some of the, favorite kind of equity plays, as a result of where we started from, because, that is really what's fundamentally, I think, going to drive things here as we get some resolution with this diplomacy.
For now, we're getting a push up in inflation because of higher energy costs. And we don't know when the Gulf will be reopened or the Strait of Hormuz will be reopened and how bad the damage is to the oil infrastructure in the region. However, you think the Fed won't be making any big changes. It won't be concerned enough about inflation?
Well, look, I mean, we've seen since this conflict began a significant repricing of interest rates, really globally, and specifically in the U.S., that was about 50 basis points on the 2-year, and all of that was the market basically taking out a large majority of cuts that we came into the year, kind of pricing into the curve. And while with these recent developments, we have seen recovery really on the equity market side of things. One thing that you would notice is on the interest rate side of things, there hasn't been a significant move there. And a lot of that is due to the fact that just like the inflation data we saw today, we're going to see economic data really for months to come kind of reflect this, higher inflation environment. And that's really going to prevent the Fed from cutting, especially in light of really where jobs came in last week, which was certainly a positive number following a weak month prior to that. Meaning, look, the economy's in pretty healthy shape, and on the margin that takes the demand shock off the table. And the Fed's really just going to, I think, stick here, for the remainder of the year. And as a result, we haven't seen nearly the move in interest rates that we have seen in equity markets on this diplomacy.
I mean, there is a volatility index for oil, the OVX index, and you reckon it is signaling that the market thinks we're not out of the woods here. There could well be spikes in oil, or there's a risk of that.
Yeah, exactly. The OVX index is certainly a lesser known, cousin to the more widely followed VIX index, which looks at implied volatility that derivatives traders are pricing into that commodity. And we peaked at around 120 just a few weeks back. Started the year around 40, and we sit at about 80 now. So look, there has been some recovery in that. That uncertainty has come off the table. But one of the things that hasn't come down yet is the actual price of oil, right? And so that's going to require this supply situation to get resolved. That is not the case yet. But this uncertainty dynamic is really important because where we are with equity markets, for example, you do not need, I think, lower rates for equity markets to get higher, but we do need lower uncertainty, and so that's that metric there is, I think, exactly one of the reasons you've seen a very strong rally in equity markets, just on that reduction in uncertainty. And look, it still tells you that the market has reduced uncertainty around those dynamics, but it's not completely gone by any means.
I'm looking at a couple of these software stocks that people have worried will be affected by AI. Salesforce, CRM, and Adobe, ADBE. There hasn't been much of a recovery in those two anyway.
Yeah, there hasn't. And look, I like that sector overall for this environment right now. One of the main reasons is because software and services sold off well before the Iran conflict. And I think one of the things that's happened as a result is you've had the entire sector really go down, and there's a lot of companies within that segment that, and the time will tell, but are not going to be negatively impacted by AI. In fact, they're probably going to, really become, dominant force in the space. And so I think a lot of, selective stock picking amongst that entire software group right now is an interesting place to look because it actually doesn't even require that this Iran conflict gets resolved in the near term. It's kind of an independent risk factor, but we have seen, a significant repricing there. And, year to date, those stocks are down in aggregate a little more than 30%. So probably a pretty good place to look for dislocations for firms there that are very integrated into business workflows and will be difficult to replace. Another
stock that's of interest to us here in Canada because of the Thomson family dynasty, super rich, is Thomson Reuters, TRI. That they did mount a big PR campaign saying we're not going to be hurt by AI. Stock bounced a bit, but it has dropped again.
Well, look, I think companies are really right now trying to race and figure out how they can integrate this transformative, productivity enhancer into their workflow. And the quicker they're able to do that, the quicker they're going to be able to separate themselves from the competition. So I think that, those types of activities are going to be crucial. And I really look forward to hearing this. We get earnings season here in the U.S. kicking off just next week, and will, be kicked off by a lot of the big banks, of course. And it'll be really interesting to hear what management says about how those integrations are going, where they are able to see those productivity enhancements, and we're really in early innings here for this technology to move its way through all sectors. And this earnings season is going to be a great place to see who's really making a difference and who's not.
Mike, thank you very much indeed.
Thank you.
Mike Dixon, head of research at Horizon. Coming up, Canada adding just over 14,000 jobs in March. Well, at least it was better than the employment losses earlier in the year. We'll have more after the break. Canada added just over 14,000 jobs in March. It was a little below expectations, but it was the first time we've seen a monthly employment gain this year. Let's get more from Travis O'Rourke, president of Hayes. So I think you had called for this something of a recovery after a miserable 2 months.
That's right. Yeah, it was a snapshot last month.
Right.
Anecdotally, what we're seeing at Hayes, what we're seeing in the market was kind of stability. And I think that 15,000 we picked up last month is a good sign of that. The more we get into the summer, I think we're going to see even more kind of upticks coming through. But overall, last month was a scare. We're back to reality.
Yeah, because it was disastrous, the previous reading. You saw a positive shift in unemployment here. Tell us what.
In unemployment, I saw lots of positive shifts.
Okay, yeah.
I would say Ontario, positive. We like that. Minor movement in construction, which is good. Right. But the most positive thing for me was to see natural resources go forward, 10,000 jobs.
Oh, so this was in employment, not unemployment.
That's right. Yeah.
Sorry,
Unemployment's probably flat.
Sure. Okay.
But sector by sector, natural resources, that's the best move that we've seen in that sector in a long time.
Highly paid jobs. Highly
paid jobs. What's interesting, if you look at maybe on the surface, the wage growth month over month at 4.7%. You can say, wow, that's great. Wages are growing across the country. But it's really a composition shift that we've had. And to your point, natural resources, higher paying jobs. So like for like, we went up about 3.6% in wages. But because there's so many more high paying jobs, the true number was 4.7. Now, the negative of that is people who are at the lower income end are having even more trouble finding work.
The kids are hurting unemployment for them, almost 14%, but at least it didn't get worse, youth unemployment.
That's right, yeah. September was kind of like our all-time worst. Last month was bad. We're about flat. But there's good news coming for kids. The government did a great job last couple of years with Canada Summer Works. There's some Ontario programs as well. Those programs kick in April 20th. So if you're a student, if you have a student in your house, it's time to get looking. There's about 27,000 employers who are approved for this summer to get subsidies from the government. And they can start getting those subsidies in 2 weeks. So get out there, find a job, get that resume moving.
That's interesting. We should have somebody on to talk about that. So you said 27,000 employers.
Yeah, so 27,000 employers participated last year. They found out end of 2025 if they were approved. So we're in the kind of like that planning phase, but they can begin to get subsidies starting April 20th. And if you're a student, get on the government websites. You get the whole list of the people who are applicable towards it. And that's where I'd start my job hunt.
Fewer temporary workers, will that make it easier for younger people to find summer jobs?
I think fewer it should, definitely. Now, when unemployment's still at 6-7%, there's a lot of people who are looking for entry-level work.
Yeah.
But traditionally, what you and I would think of as a summer job would be, travel, accommodation, food services, some of the agricultural parks work. That isn't usually where you're competing the most, I guess, with temporary workers. But there should be lots of jobs just because immigration has been far lower than it was the year prior.
The biggest growth, though, over the past year, anyway, year on year, has been healthcare and social assistance.
Yes. We don't love that. We don't love that because that's not, like we talk about natural resources being huge. Like 40% of Canadian merchandise exports go to oil or minerals in some way, shape, or form. So when I see 10,000 jobs added in natural resources, we love that. To see, healthcare and social services being our #1 job growth over the last year, That's a lot of public sector or public sector adjacent work, and it's the sign of an aging population. So on the one hand, you're going to have skill shortages, and the other hand, healthcare and social services going up. Collectively, that's a bad sign for an economy that's looking to grow.
There's a look at unemployment rates by province, and Ontario's had a hard go of it there. You can see the rate well over 7%.
Yeah, Ontario's really been hit a lot with manufacturing, and I think the initial kind of, reverb that comes off of the tariff talk, particularly automotive, that was bad. Then you had steel, that was bad. So Ontario's been really, really hurt.
And home construction has struggled in this province as well, particularly in Canada, in Toronto, I mean.
Home construction has struggled, but what Ford and Carney have done a great job with over the last month or so is helping to address new home builds. So two big moves. We saw about $8 billion deal between the provincial and the feds to cut out development costs or halve development costs, which is going to be great. And then they also did a good job cutting HST off of any new home under $1 million. So collectively, according to the government, it could save you about $200,000 off of a new home.
It's amazing. Yeah.
Whereas you look in BC, who has neither of those subsidies, and they are shedding construction jobs every single month. So two different provinces, two different strategies. One's paying off and one's not.
Travis, thanks very much indeed.
My pleasure.
Travis O'Rourke, president of Hayes. Up ahead, Piper Sandler just downgraded Nike amid questions on whether the athleisure boom has peaked. Stick with us. See pressure on Nike today. That stock has slid over the past year. It got a downgrade at Piper Sandler. Piper Sandler is concerned that the athleisure movement, people going around in sports gear and yoga wear, may be trending towards oversaturation. Maybe it's past its best. Let's get more on Nike from Anna Andreeva, Managing Director at Piper Sandler. Anna, thank you very much indeed for joining us.
Of course. Thank you so much for having me.
Before we get into Nike, this whole athleisure thing, people would show up in tracksuits or sweatpants. You think that may be losing its cachet, people getting a bit more formal?
Yeah, I think there's some of that definitely going on. There's been, a bit of a shift towards dressy, as echoed by a few companies in our space, and that relates really specifically to footwear. But when you have, a footwear trend towards dressy that's working, that would suggest the overall wardrobe, is changing as well, and away from some of these, athleisure type of a silhouettes. Specifically in our coverage, Steve Madden has been a kind of a fast fashion, company in the footwear space that has been calling out this shift towards, heels and pumps and boots and et cetera, really since last back to school. And that's also, echoed in some of the data that we see. So yeah, we do think there is a change a bit in the wardrobe that's happening across the industry.
Talk to us about Nike. They just are out of favor with investors. You just downgraded them. What is the biggest challenge, do you think, for the company?
Yeah, I think, the size of a company is definitely a challenge when you think of turnaround. This is a company that does, $46 billion in sales. That's just an unprecedented number. And over the last few years, the marketplace has really changed. I mean, we've never seen this many, competitors, whether it's on running or Hoka or Brooks or New Balance or, Solomon, which we cover, which is part of the Amer brands portfolio, that are, very much on offense. And you have an industry that has pretty long lead times. And even though, the CEO, Elliott Hill, has now been at the helm of Nike for about a year and a half, I think the challenge is that, he inherited a company that has not innovated, previously, and specifically as it relates to some of the more casual silhouettes. And we talk in the note, today about classics. That's been a reset that's been happening for some time. Unfortunately, there just hasn't been enough innovation from the company outside of running to really begin to regain that share. So we worry about that. And this is happening at a time when, if you take a look at, frequency in terms of how often, the consumer buys shoes and especially sneakers, according to our research, these frequency metrics are pretty much at peakish levels, especially with the younger, teen consumer who tends to be more of a trendsetter and, is faster to adopting some of these, fashion trends. So in an environment that we have, today, consumers certainly, a little bit fragile, very competitive marketplace, long, lead times, and these frequency metrics that are pretty peakish in our view. I think that all bodes, for a pretty long turnaround when it comes to Nike.
One thing that jumped into my mind here, and I don't think it's that important, but they came out with their World Cup jerseys. And they're getting good reviews, the American one, the Canadian one. But I'm not sure if you've seen these stories. Apparently, they bunch up at the shoulder. And people are complaining about it. It's a quirk, I know. But it must be an annoyance for Nike, the World Cup being such a big deal for them.
Yeah, it's early with the World Cup. I mean, it's an interesting observation. I mean, we've seen this again. This still very early days. This will be primarily a jersey type of a business. There should be, some kind of a brand heat extended from that towards other, silhouettes and hopefully in footwear as well. And you do have World Cup, taking place in the U.S., which, certainly that should be a very good thing for Nike. But, at the end of the day, these dollars that you get from World Cup, next year you have to worry about the comparisons and lapping those. So, the kind of the one, 1 year nature of this phenomenon, we just don't think that's enough to get excited for the brand heat of Nike coming back.
And can you remind us how important is China? Just touch on that, if you would. Because for a long time, I believe Nike kept its prices high in China, wanting to maintain exclusivity. What is the more recent story?
China has been really under pressure for some time. I mean, it's the worst performing geography for Nike. And, historically, China's profitability was the highest out of the other geographies for the business. Now it's come down, pretty significantly on all the sales deleverage that they've seen, and also moving through some of the underperforming franchises such as classics that they've talked about, and cleaning up inventory in the channel. That's taken some time. So far, there really hasn't been a kind of a clear-cut, strategy that's been communicated to the street from the company as to how to fix China. And again, this China turnaround has taken longer than investors would have hoped. I think you have, really a combination of things. You have the national brands that have become, pretty prominent. You have some of the emerging brands out there, some newcomers, whether it's on running, whether it's Hoka. Salomon has been doing very well in the region, as well as Arc'teryx. So we think Nike is just in a really bad spot in terms of navigating, some of these challenges. And again, it comes down to the fact that, the innovation pipeline, kind of at the pace of that pipeline is taking some time as well. So far, China was a little bit less bad, if you will, this past quarter that they reported last week. They kind of signaled that, the out quarter sales will be down in the 20s. So it's really quite a headache. Nike does plan to have an analyst day at some point, later this year. And I think that will be an important forum to learn, how is the company planning to navigate some of these challenges.
We're very tight for time. Just give us, so you've brought you brought Nike down to neutral. What about Lulu? What's your rating on Lululemon? And where do you see them fitting in? They're a big player in athleisure too.
Yes, no, for sure. Yeah, so, Lululemon, it's a bit of a wait and see story for now.
Hmm.
We're neutral rated on Lulu. We are waiting, like everybody else, for a new CEO announcement,
Hmm.
which, we expect to come in probably next few months, time frame. I think it's a little bit difficult to really, do anything on the stock until we know who that person is. Lulu also will be a turnaround.
Hmm.
We do think, the athletic category overall is, very competitive and very crowded. Lulu doesn't have the problems quite like Nike does in terms of that, negative China exposure.
Hmm.
But again, I think it remains to be wait and see until we get the leadership announcement.
Anna, thank you very much indeed. Anna Andreeva is managing director at Piper Sandler. Coming up, Ottawa is putting more than $1 billion behind a major expansion at the Port of Montreal. We're going to get more from the Minister of Transportation after this. Shares in Cascade are down. The company has cut its first quarter earnings outlook by more than $10 million. This is a Quebec-based paper and packaging company. It says the revision reflects weather disruptions in the U.S., higher transport and fuel costs, and ongoing political uncertainty. However, it does say it remains committed to a long-term goal of improving profit. And shares in MTY Food Group, operator and franchisor of numerous food court brands, under pressure today. This is the owner of Cold Stone Creamery and Mr. Sub, for example. It posted revenue in its latest quarter that missed estimates, dropping 6% year over year. MTY also saw a decline in corporate store sales in the United States. However, the company did post higher profit, largely though driven by foreign exchange gains. And shares in Taiwan Semi trading higher after the main chip maker for Nvidia and Apple reported a surge in revenue in its latest quarter. Sales in March rose 45%. Investors see the results as positive, adding that they quell concerns that the Iran war will slow demand for AI data centers and devices. And the TSX higher today, hanging in to end the week. Let's have a look at the US markets. No clear direction as investors await those talks between the US and Iran on the weekend. The Prime Minister has broken ground on a long-awaited port expansion at the Port of Montreal. This is the first project to move forward under the auspices of the new Major Projects Office. Overall, this expansion is expected to cost $2.3 billion, and the idea is to double the port's container capacity. Let's get more from Stephen McKinnon, Canada's Minister of Transport. Stephen, thanks very much. Minister, thank you very much indeed for joining us.
Hello, Andy. Thank you. Thanks for having me.
So the Canada Infrastructure Bank is putting in a loan of almost 1.2 billion. So paying a good chunk of the money. So will the taxpayers get that money back eventually?
Oh, absolutely. This is a repayable loan, and the Infrastructure Bank is playing the role it was designed to play, which is to enable major infrastructure projects that expand our trading capacity, that help us diversify our export destinations in Canada. We know that on the East Coast, we are rapidly running out of container capacity, and we'll in fact be in a position by about 2030 where we absolutely need more space. So this project is as timely as it is needed.
It is flexible, though, apparently, according to the Globe and Mail, on the repayment schedule. It depends how much their business actually grows at the port.
Yes, and of course, the missing piece here is we will be, the port will be, I should hasten to say, they are an independent agency. We'll be signing an agreement that will include private funding with the terminal operator. and that will comport many performance objectives, and we'll make sure that this represents not just a good deal for Canada, but a good deal for taxpayers.
The port has been hurt by labour disputes over the years. So has Vancouver as well. And this has been cited as a problem with Canadian ports. Now, I know it's a complex problem and you're not the labour minister, but is there any sign of a long-term solution to that?
Well, good news on that front, Andy. I've given a series of speeches, including one in Toronto just recently, where we've identified, of course, the need for predictability and stability in our supply chains, and that includes labor relations. You know, there are some great careers in transportation and in logistics in Canada, but we need to address this issue that keeps coming up about Canada's reputation. We want to be a predictable place to do business. We want to be one of the best countries in the world at transportation. We have a number of things to address. Labor relations is among them, and ports are obviously an important component in that category. I was the labor minister. I am no longer the labor minister through a couple of significant port disputes that we rounded off to binding arbitration. And we need to find a more sustainable way to address those labor relations issues, make our performance predictable, and get Canada to become that transportation powerhouse we need to be.
What can you do, though? It's tricky, though, isn't it? Resolving a problem like that. The workers, naturally, they want higher wages, especially if they see more business going through the port.
Yes, indeed. But we need modern ports, too. Canada's prosperity requires us to be as good as Australia, South Korea, Singapore, some ports in Europe who have, let's agree, leapfrogged Canada on the technological front, on the stability front. And a lot of what I've been saying, Andy, is that we need to take on all of these issues, take on our supply chains as a national project in and of themselves, make them work better, get projects approved more quickly, intermodal facilities, port facilities, railways, spur lines, transportation to new critical minerals projects. You know, the world is looking for what Canada can supply. And my job as transport minister is to get those things off of our shores into foreign markets, create value and wealth for Canadians and for Canadian companies, and do that as efficiently as possible.
That's interesting. Do you think the Aussies, who've got a broadly similar economic system and society, they've done a better job on these things?
They've done a better job on ports. I'm specifically talking here about what we call paperless trade. You know, so many shippers need to fill out so many forms, and they literally are, Andy, forms. Some of these processes run sequentially when they should run in parallel. And, you know, there are great examples all over the world, and the Australians are among them, of logistics systems that cause, that they make it easier to turn a ship around. Turnaround times in our ports are absolutely critical for efficient ports, but they're critical for our exporters too. We do not want boats lingering in harbors or at anchor. We want them working, moving Canadian goods to foreign markets.
What about this problem of crime at the port? The CBC had a story just this week, I'm not sure if you saw it, that shippers saying that it's saturated with, the city's export industry is saturated with organized criminals who ship stolen cars out of the country. Now, I know that's not part of your remit either, but we have heard this. It's kind of disturbing about the Port of Montreal.
Well, I don't want to talk too much about it. My colleague, Gary Ananda Sangri, responsible for the Border Services Agency and for obviously the RCMP, I can assure you that they have taken many measures to address the issue of auto theft at its point of origin, of course, which is in our communities, but at point of export as well, and making a lot of headway. It involves scanning technology. It involves, as many of your viewers will know, just getting better at predicting the behaviors that are easily seen, and making sure that we're addressing this problem at its origin. But should that bleed into our logistics system, being able to, without inspecting every container, being able to address this problem where it exists. And obviously, many people observe that ports are a locus for this, and they can be assured that we will be all over that.
It's not unique to ports in Canada, for sure. Just finally, so this is, I believe, going to double the container capacity. So is there really demand for that? Or are exporters saying, hey, we wish we could get containers out at a much faster pace?
Well, what you're seeing in the container business, it's getting more efficient. Yes, we are running out of container capacity. We obviously want to also upgrade our ability to process containers, and new facilities help us do that. But yes, Montreal is projected to be out of space in the next several years. So we need to get to work, getting building. That's equally true on the West Coast. So more news to come there. Major port expansions are an important part of the government's agenda to build Canada strong and to get our products to markets other than the United States. The United States always going to be an important partner, but diversifying Canada's trade is an urgent priority, one we're investing in, and one I can assure you, Andy, you're going to start seeing a lot of results from.
Minister, thank you very much indeed. Stephen McKinnon, the Minister of Transport. Still ahead, we are going to check in with Bloomberg Canadian finance reporter Christine Dobby. She has thoughts on this oil shock that's rippling its way through the Canadian economy, not to mention other nations. This is always a Friday treat. It's time to check in with Bloomberg's Canadian finance reporter, Christine Dobby. She writes the Bay Street Edition, a weekly newsletter covering all the latest news in Canadian finance. Christine, you always come up with a vivid phrase, rockets and feathers. Tell us why that has been applied to oil and energy prices in the past.
Hi, Andy. Yeah, so, with the Iran ceasefire being reached this week, I think a question that a lot of people had from an economic standpoint, at least, was, well, oil prices are starting to come down. What will this mean for prices, particularly in North America? That's what I was looking at. And something that I've started to hear as I've been listening to podcasts and reading articles is the term rockets and feathers. And it's this idea that was coined by an economist in the 1990s that when crude oil prices go up, gas prices also go up and they shoot up like a rocket. And when crude prices come down, gasoline, retail gas falls like a feather. It takes a lot longer to come down. So I was looking at that today, or in the newsletter today, and also, how far can we apply this beyond just the price of gas at the pump?
But Trevor Toome, the well-known Alberta economist, he's skeptical. He says usually gasoline prices do come down, but we're just less sensitive to that. But we do smart. It hurts when they go up, so it's more stands out more.
Yeah, his take is that that it's more of a psychological hit when prices are going up, and we feel that a lot more, and we adjust our behavior in some cases. His argument is that if you look at the historical price movements of crude oil and retail gasoline prices in Canada, you see that the gas prices do come down pretty much in line with the crude prices. But what we are going to feel in this case is that there's going to be an extended period of supply chain disruptions that have been caused by this situation. Even though oil prices have come down since that ceasefire was announced, they're nowhere near what they were before the war, right? They're just, if you look at the WTI right now, it's just under $100 a barrel, and they were, about 55 back in January. So that's still a huge adjustment that ripples through the economy. For instance, with food prices, agriculture is a massively energy intensive industry, and it's gotten used to cheap energy over the past few years. Fertilizer production is massively energy intensive. And as we know, fertilizer has also, the supply of fertilizer has also been impacted by the war. So there's going to be effects on all of these kinds of prices that stick around for a long time. So it's almost like we will see that rockets and feathers phenomenon, even though it's not directly related to the price of oil and retail gasoline.
It's interesting. I'm not sure if you saw Ireland or the capital has been paralysed by farmers and other big fuel users blocking the streets, and I wonder will we get any of that malarkey in Canada? Apparently in Norway it's breaking out as well, but Dublin has just been paralysed for a few days. Other stories you're watching: RBC setting up this new fund, trying to discourage Canadian entrepreneurs from moving abroad. Now, the banks over the years have come under criticism for not being as supportive of startups as they could be.
Yes, so we don't have a ton of details on this yet, but CEO Dave McKay announced this at the bank's AGM yesterday. They're planning to spend up to $1 billion over the coming years on this fund, which is meant to invest in companies. And it's suggested that these are early stage, sort of more venture capital type investments. And part of the goal, the stated goal, is to help those companies grow and stay in Canada. I think there is going to be some tying to some of the venture capital investing wing that RBC does already have. The banks don't have huge venture capital investing wings, but yes, as you say, they are coming under pressure, as are the pensions, which have a lot more money to spend to support business and the economy here.
Thank you very much. Always great hearing from you, Christine. Now, we didn't even get to talk about the Artemis space mission, but okay. We'll find an excuse to go back to that next time. Thanks very much.
Thanks.
Christine Dobby of Bloomberg. Still ahead, movers with Bloomberg's Natalia Kniziewicz. Let's check out the stock action south of the border. We're joined by Bloomberg's Natalia Kniziewicz. Natalia, thank you very much indeed. One trend that's showing up, retail investors turning into sellers. There is some skepticism about this recovery in stocks.
Exactly. That's quite an interesting week we are watching in terms of like who is buying, who is selling stocks. So, for example, on Wednesday, when we saw this big jump in the S&P 500 and other indexes, retail traders finished the day as sellers. At one point, they have been selling ETFs at the fastest pace in a year. They finished also the day with the lowest exposure across ETFs in more than 10 years. So it tells us that retail traders are becoming more skeptical. It's also a big shift from their kind of usual, view on the market. We know that they have been buying the dip consistently for years. So now they are becoming more, maybe pessimistic. We'll see how it plays out. And then it's also important to take a look at what other types of investors have been doing, because what was driving this rally? Data shows that hedge funds have been just covering short positions that they have accumulated over the past few months. And as a result, of course, we saw this huge jump in U.S. stock price, stock indexes, because they had to cover like macro products, ETFs, indexes, etc. And now it all goes back to a point like, do people want to include more long positions, or it was just a short covering rally? I think next week will be crucial in terms of like what people really want to do with this stock market exposure.
We're tight for time. What about Q1 earnings? What's the expectation there?
Yes, the bar is very high, actually. Analysts expect 12% EPS growth. It's pretty, high, and they have been raising expectations despite this volatility and the stock market sell-off. But I need to point out that this high expectations comes at a time when the exposure across all types of investors is low. It means if we do have positive surprises, people will be more willing to buy the dip.
Natalia, thank you very much indeed for joining us. Natalia Knežević of Bloomberg. That wraps up this edition of Trading Day. Thank you very much indeed for watching. Have a wonderful weekend.